Welcome back to the Deep Dive. Today we're skipping the headlines and going straight to an institutional-grade pre-market analysis. We're looking at the week ahead, specifically Monday, November 24th, 2025.
And the big story is this apparent neutral market sentiment.
Exactly. It feels neutral, but it's running head-on to some really deep structural problems. We're talking futures ES, NQ, RTY volatility, and I think most importantly, where the big cross-asset correlations are starting to completely break down.
Yeah, it's absolutely critical that we move beyond just that neutral label. I mean, that label is really a mask. Our whole mission this morning is to identify the subtle mechanics happening under the hood.
The tire structure.
The microstructure, the order flow dynamics, because that's what's screaming for a proactive, defensively tilted strategy. If you're just reading the surface narratives, you are going to miss these divergences. And that's where the real risk is.
Okay, so let's unpack that. We can start with the engines of the market, the futures complex. When everything feels so neutral, directionally, how do you even begin to assess liquidity in the S&P, the NASDAQ, and the Russell?
Well, the first thing is a conceptual assessment of the order book. I mean, before you even look at a chart, we're looking for evidence of thin order books away from the overnight highs and lows.
So like a shallow pool of water.
Exactly like that. A shallow pool where any small splash creates huge ripples. Thin order books, they just signal market fragility. It means a tiny order can move the price way more than it should.
And that fragility, it has a direct cost, right?
It absolutely does. We monitor the bid-ask spreads. If the spreads on ES, NQ, and RTY are wider than usual, that's your first red flag. It means more friction, higher costs to transact, and it's a clear signal that the market just isn't willing to participate fully.
Which points to a choppy open.
It points directly to a much choppier, less predictable open. And beyond that, we're also watching dark pool activity. You know, those big institutional block trades happening off exchange. That gives us a qualitative read on whether smart money is quietly buying or selling.
That brings us to a really powerful idea in market structure, which is identifying trapped traders. Why is finding those people, the underwater buyers or sellers, so important for figuring out the next move? They're basically the fuel, aren't they?
They are the force momentum. A trapped trader is, someone who put on a position probably with a lot of conviction at a key overnight level, a high or a low.
And then the market just slammed the door on them.
Instantly rejected it. So now they're sitting on a losing position and they have this inherent urgent need to get out.
So those rejection points, they become magnets later on in the session.
Precisely. They become prime targets for what we call liquidity grabs. The market will literally go back to those zones to hunt for the stops of those trapped traders.
To trigger the cascade.
To trigger that cascade of orders. The forced selling, the forced buying, that's what fuels the momentum for the next real leg of the move. And we use volume profile to find this. When you see a high volume node, an HVN, clustered right near those recent extremes, that's where the trapped positions are hiding.
Got it. So the HVN is like a map showing us where the most money decided they were right, only to be proven very wrong very quickly. Okay, so that sets the stage. Let's talk about the indices themselves. When you see ES, NQ, and RTY moving differently, that non-confirmation usually means volatility is coming. How do you see the relationship between the big three right now?
Well, we assign them personalities. It helps us decode their behavior. ES, the S&P, that's the boss. It's the broadest measure of what institutions are actually doing.
And the NQ?
NQ is the fake-out artist. It's all momentum, all volatility, and it often leads these moves that just aren't sustainable because they're driven by, 5 mega-cap tech stocks.
RTY, the Russell 2000, you always call it the snitch.
It is the snitch, yes, because RTY gives you the clearest signal of true broad market risk appetite. It's domestic economic confidence in one number. So here's the critical non-confirmation. If NQ is making these big, flashy moves up, but ES is only kind of half-heartedly following.
And the RTY is just sitting there.
Or even worse, it's lagging. That tells you the rally is incredibly fragile.
I see the RTY as the snitch because it reflects pressures on small businesses, but isn't it also true that its lagging can sometimes just be about inflation hitting small business margins harder than, say, big tech? Is it always a risk signal?
That's a very sharp point, and you're right, it captures both. When RTY lags, it tells us the rally is narrow, and a narrow rally is a structural fragility no matter the cause. But when it lags aggressively while the others are pushing higher, it also tells you that the confidence needed for real cyclical growth just isn't there.
So money is hiding in the biggest names.
It's hiding. It's not seeking broad exposure. And that persistent non-confirmation is one of the highest conviction signs of weakness you can find.
Okay, let's pivot from the indices to the big picture systemic risk indicator. Volatility. We all look at the VIX, but how does the VIX term structure, the futures curve, really show us what the market is afraid of down the road?
Yeah, the term structure is just how traders are pricing volatility insurance premiums over time. It's that simple. It compares the price of VIX futures expiring soon to those expiring months from now.
So walk us through the two main states, the normal one first.
The normal state is Contango. The curve slopes up, meaning longer-dated futures are more expensive than the front month. That's normal because insuring against a crisis 6 months away should cost more than insuring against one right now, assuming things are calm.
It suggests complacency, or at least that things are balanced.
Right. It implies that while today might be quiet, the market expects volatility to eventually revert to a higher long-term average. It's a state of equilibrium.
And the panic state.
That's backwardation, an inverted curve. When the front-month VIX futures are trading way higher than the later months, it means the immediate threat is so bad that insuring against the next 30 days costs more than insuring against 3 months out.
That's the 5-alarm fire.
That's the definitive signal of immediate, intense fear. It's what we saw glimpses of during the COVID crash.
So for today, for our hypothetical November 24th, the spot VIX is up at 23.43. It's elevated after a recent spike near 28. But the term structure is still in contango, even if it's a bit flatter. What is that telling us?
It's telling us two things at once. First, the acute, immediate panic that pushed VIX towards 28 has cooled off a little. The market isn't bracing for a crash tomorrow.
Okay.
But, and this is key, the high absolute level of the VIX, even in contango, shows that participants are pricing in persistent uncertainty. They think this turbulence is the new baseline. It's not complacency at all. It's just sustained medium-level worry.
That sustained worry.
Yeah.
That's a perfect segue into the big macro signals. We talked about this risk-off rotation that's happening even with the neutral label, and it's all driven by a huge cross-asset divergence.
It is. You've got equities looking very vulnerable. The NASDAQ 100 is positioned for its worst month since March. There's a real sentiment shift from greed to fear, especially around some of these stretched AI valuations.
But that's just one piece of the puzzle. What's the piece that doesn't fit?
The puzzle is the U.S. dollar versus Treasury yields. So the 10-year Treasury yield, the U.S. 10Y, has eased off a lot. It's down to 4.06%.
Which is classic defensive behavior.
Textbook. It's driven by the market betting on a Fed rate cut, especially after some dovish comments from Fed officials. Falling yields usually mean flight to safety, slowing economy.
And in that standard playbook, if yields are falling because the economy is weak, the U.S. dollar gets hammered.
The dollar should be the weak sibling in that relationship, but that's the correlation that's completely failing right now.
Because the dollar is strengthening.
The U.S. dollar index, the DXY, is surging. It broke above that key 100 level, and it's up over 1.4% for the month. A strengthening dollar, despite falling yields, is a really powerful, counterintuitive signal.
So it's telling us that there's some kind of structural demand for dollars that's overriding the interest rate story.
It is. It suggests global financial uncertainty, maybe instability overseas, or just the idea that even a slowing U.S. is still the cleanest shirt in the dirty laundry. It's a signal of relative strength.
And that acts as a massive headwind for risk assets everywhere.
A huge headwind.
Okay, speaking of headwinds, let's nail down the most immediate risk for this week. Market liquidity. We've seen drains before, but what's tightening the system right now?
The immediate quantifiable risk is a massive liquidity drain that's just timed horribly. We're looking at nearly $150 billion in Treasury settlements hitting the system this week.
Wait, $150 billion? In a holiday-shortened week.
Exactly. It's a huge amount of cash that has to change hands when market capacity is already low.
And that cash has to come from somewhere. The buffer that used to be there, the reverse repo facility, isn't really an option anymore.
That's the critical link. The reverse repo, the RRP, which held all that excess cash, is basically depleted. So the cash for these settlements has to be pulled from two places: by selling risk asset stocks, bonds, and by drawing down commercial bank reserves.
Which is a problem because we know those bank balance sheets are already fragile.
The fragility amplifies the pressure. U.S. banks are still sitting on, around $395 billion in unrealized losses on their securities portfolios.
And why does that old news matter today?
Because a liquidity squeeze can force those unrealized losses to become realized losses. If a bank has to sell those securities to raise cash, the loss becomes real. And that instantly tightens lending standards and kills risk appetite across the entire financial system. It's a very vulnerable setup.
This kind of tight funding environment makes the distinction between a true safe haven and a speculative asset absolutely critical. So let's compare gold and Bitcoin. They're often lumped together, but right now, they couldn't be acting more differently.
They're worlds apart. They are serving two completely different masters. Gold is doing exactly what it's supposed to do. It's a robust, structural safe haven.
I mean, the performance is there, up over 17% year to date.
Hit historic highs in October. And this isn't just fleeting strength. It's geopolitical instability, sure, but it's also critically unprecedented buying from central banks. China, India, they're all accelerating their de-dollarization plans. Gold is showing rock-solid diversification.
And the digital gold narrative for Bitcoin, how's that holding up under pressure?
That narrative has completely fractured. Bitcoin has had a significant, persistent correlation breakdown from any safe haven role. It's now highly correlated with U.S. stocks, specifically 46% with the NASDAQ 100 and 42% with the S&P 500.
46% with the NQ. That means it's basically just a leveraged tech stock at this point.
It is functioning as a high beta tech play. Full stop. It's vulnerable to the exact same liquidity drains and sentiment shifts as speculative tech. For a portfolio that's actually trying to preserve capital right now, Bitcoin just isn't offering that hedge. It's purely a risk-on asset.
Okay, let's wrap this up with positioning. Where is the majority of the market right now, and what's the shift that would cause the most pain? What are the big pain trades?
I see two dominant positions that are really vulnerable. The first is the massive crowding into the long-duration trade. Investors are just piled into long bonds, betting aggressively on Fed rate cuts next year.
So the pain would be if inflation is stickier than they think.
The pain is a reversal. If we get higher for longer in a real way and yields are forced to surge again, that would be catastrophic for those long bond positions.
And the second pain trade revolves around volatility itself.
It does. Even with the VIX elevated, a lot of strategies are short volatility, betting on this slow grind up. And because the term structure isn't inverted, they feel confident. But a sudden shock, geopolitical, and earnings blow up could trigger a violent VIX spike.
We saw that in early 2018, the Volmageddon.
Exactly. When the VIX jumps 5-10 points in an hour, it forces liquidation across the board and creates this horrible cascade.
So if those are the pain trades, what's the single biggest structural mispricing the market is making right now?
The market is fundamentally underpricing the shift to a persistent higher inflation regime. Everyone is priced for a soft landing, a smooth glide path back to 2%. But the structural forces, deglobalization, higher wage growth, massive fiscal spending, they all suggest inflation could be much more stubborn.
And if the market is wrong about that soft landing, what does that mean for how you build a portfolio?
If inflation is stubborn, you get a harder landing, or even stagflation. And that forces a severe repricing. High multiple growth stocks get crushed. Their future cash flows get discounted into oblivion.
And what works in that world?
Value stocks, commodities, inflation-linked assets, they would substantially outperform. And long-dated bonds would continue to get hammered as real yields rise.
So the portfolio imperative here is pretty clear.
It is. This neutral segment is a deception. It's covering deep fragility and risk. It absolutely mandates a highly selective, risk-averse posture. You have to reduce exposure to high valuation equities, maintain your structural longs in physical gold, and just accept that Bitcoin is a high beta risk asset. It is not a diversifier right now.
That gives you a crystal clear mandate for the week. And as you move forward, we want you to consider the long-term implications of this tightening global liquidity environment we discussed. Think about those huge mandatory Treasury settlement drains. What actually happens to the price floor of risk assets when the structural excess cash that's available for settlement is consistently being pulled out week after week from already vulnerable bank reserves?
That structural cash drain is the fundamental question that demands institutional attention.
You now have the institutional perspective on today's dynamics. We'll see you next time on The Deep Dive.